All right, well, first article today, home prices rise at the fastest pace since November of 2022 from Yahoo Finance. Now, okay, it's already, May of 24. We're referencing November of 2022 because it was the last fastest pace. Yeah. But now here we are again with them rising once again, even with rising interest rates.
Yeah, no, it's crazy. And I think we're going to continue to see this type of market, right? It's simple economics, like I've said in previous times. It's supply and demand. We just don't have enough inventory that, for the demand of homeowners. Even with this affordability issue that we're currently facing, we still seeing these trends. And some of the key drivers, again, it was a low inventory of this. And as we continue to see this, Andy, with the demand for housing is just going to continue. It's just going to, it's just the fuel.
Yeah. So I wanted to tell you something that it kind of just happened to me. I had a conversation with someone who's a franchise owner of a business, and I was having this private conversation, and I said, it's someone I've known for a very long time.
Yeah.
And I said, without being rude, I feel like you might have overpaid for this franchise. And this was his answer. It was my only way to get in.
Wow.
And now this is a business. It wasn't a home. It was a company. And he's like, it was my only way to get in, was to buy the franchise from the current franchise owner. And that was going to be the price I had to pay.
Wow.
And it made me think of this because, so in the article, we're talking about the S&P CoreLogic Case-Shiller Home Price Index. We get this from CoreLogic, and it says prices nationwide rose 6.4% over the same month year over year. Now, that is a really healthy appreciation in a normal market. That's an even crazier appreciation after the rampant appreciation we saw in 2020, 21, and into 2022.
Yeah.
And so to my friend's point of like, hey, my option was I either buy this with a higher sticker tag than maybe it's worth right now and just have to hold it longer, or I don't get in at all. And I'm feeling like that is the sentiment that's happening among home buyers too. It feels a lot like you're mentioning affordability and inventory. It feels like it's math versus like desires.
Yeah.
Like the math says I can, my desire is I want to, so I'm going to.
Yeah.
And even though I have to overpay right now, short term or whatever, long term at some point, that's going to come back and it's going to work in my favor.
No, it's so true. It almost becomes like the new norm.
Well, right. And I know and I know for some people, and I've been reading the comments, it's discouraging. I mean, this used to be a place, the United States, used to be a place where we could, have two incomes in the house and both people working full 40-hour weeks. And that was good enough.
Yeah.
That just doesn't cut in it right now.
No. And you know what? I don't blame them, Andy. I don't blame them. I feel what you just said right now, it makes perfect sense. You're buying something where, if I don't get in it now, then what else am I going to get into? Yeah. I mean, we're facing these situations right now. Again, we're in the trenches. We're actually originating loans. We get to talk to the listing agents, buyer's agents. So we're really having these true conversations with them as to what is happening in the market. How should I present these offers? How do I stand out more so than the average person? But at this point in time, that doesn't even seem to be the case anymore. It's like, no, bring me the highest and best, and then we'll take that. And then make sure that your contingency timelines, once you enter into that escrow, are so shortened to help the sellers feel that reassurance, hey, your buyer is going to close. And this is kind of like a catch-22 for a buyer and a seller, right? For the seller being that, well, rates are so high, I got to make this move somewhere else. I got to shorten these contingencies. I got to get what's going to be best for me in my current situation. And for the buyer, that's like, wait a minute, you want me to close in 10, 15 days? We're like, is there enough inspections that I can do during that time to allow me to go in there with the confidence of being able to, sustain this property? And they don't have the choice. Just like you said, hey, there's just no choice. I got to get in there.
But you bringing up confidence is a big, huge component of this. It's a big deal because what you're talking about is if people that are mathematically qualified to get in the market and they are desiring to be an owner, even if they're overpaying, it breeds competitiveness.
Yes.
And that competitiveness is going to come either with, I'll say, confidence or maybe even sometimes some arrogance on behalf of the buyer or even the seller. And I'm noticing it become a much more obvious behavioral shift than it is just, I'm going to buy a house. Like there's some very core, like fundamental beliefs. Even, last week's show, we talked about how millennials are like grouping up together to buy homes with friends. that's emerging, and there's more people doing that. That's a new approach. That's a new behavior. That's a new style. That's a new attitude about it. And again, even in that situation, they in most cases probably had to bid someone else out. That competitiveness had to show up in order to get your offer accepted.
Yeah, and now once you have 2-3 partners in a transaction, it just seems like you could sustain a little more if things go sideways, right? Because now you share that risk with 2-3 other people.
Yeah, there's less to make up. I mean, if I'm the primary, let's say, borrower, and I have 2 roommates, well, if one of my roommates bails, cool, I only got one person to replace, not like me replacing myself by myself only, and me carrying all the 100% of the load.
Yeah. You know what I like about this headline here? The home prices rise at the fastest pace since November 2022. Remember, in that year of 2022, we had one of the shortages, like very low inventory.
Yeah.
At that time, I want to say it was like 256,000 homes available.
Yeah, around that.
Nationwide. So seeing that now we've been gaining more traction, we've been gaining more inventory, to see these staggering numbers still increasing, it's still pretty wild.
Well, and that's the thing that's kind of defying the statistics, and also I think confounding the Fed. Even though the Fed's not directly involved in housing, I think it's confounding the economists, the analysts, and everybody. Is like, well, I mean, people are clearly qualifying because the mortgage industry as a whole is still lending money where it's lending money. You haven't seen a massive spike of cash buyers, right? You see corporate buyers, right? But you don't always see cash buyers. It's not like there's a 90% cash buyers all of a sudden.
No. They're actually taking 28 to 30% are the cash buyers, the investors. So
and even then, that's up from like maybe 22 to 25%. Yeah. So like that range, it's not like it's become some astronomically statistically significant number.
Yeah.
It didn't go from 25 to 60 or 90%. But we have this appreciation. So again, it's like if you're in the game and you own a home, the appreciation is welcomed, and you're like really happy. Congratulate yourself.
Yeah. And I mean, one of the things I want to tell everybody is just right now with the whole financing situation, how to finance a home. Andy, can we say that in the next 5-10 years, financing is going to be easier or more complicated?
It'll be more complicated.
Right?
Yes, absolutely.
That's how it feels. And so it's just crazy to think that.
Go in the rearview mirror. And 5 years ago, was it more or less complicated? Yeah. It was easier. So was it easier 5 years ago?
Yeah.
Was it easier 10 years ago? Yeah. It's just gotten more complicated, more difficult, more paperwork, all that. And again, even in doing that, you still have all these other variables that are reacting to the market and causing this elevated prices, elevated interest rates.
We didn't even tap into why also we've seen this increases, because we also saw a brief dip in interest rates. Yeah. And it was brief. It was like almost really brief, right? Because October was one of the highest, the rates that we've seen.
Yeah.
And then we started seeing kind of that easing. And then here we are again. Yeah. Like we're predicted where the Fed met, and they're saying, some people are saying they may increase the rates again. I sincerely doubt that.
Yeah, we're gonna get to that because there's a problem that's brewing that they're gonna have to address.
Yeah,
and in the meantime, you have these places that are people in the market that are gonna benefit from the appreciation, and people that are basically outside the market chasing it. Article here cites on a monthly basis Seattle, San Diego, where we're at,
San Diego,
and San Francisco saw the largest jumps in home prices over the prior year. San Diego, Detroit, and Chicago saw the biggest price increases. So largest
Detroit,
Chicago, money's going back to Detroit and Chicago. So many people have fled those areas. But anyways, I think that's a different reason. But there's a shortage of homes that we've been talking about. Mortgage rates are going to probably prevent even further appreciation or faster appreciation. Yeah. So it might stabilize around this 6% annual. But I mean, even then, I think predictions for this year was still like 3. It was still positive. It wasn't negative nationwide. We've talked in the show in the past, there's pockets of the country where their pricing is 10% down or 8% down. And there's pockets where San Diego, it's like 11% up.
That's correct.
Okay. Yeah. So we're like 11.3, I think was the last reading I saw, or last stated quote here on the show.
I mean, some people in some areas, they can't even it's not even worth them putting their house on the market. No.
Well, yeah, because they have to replace it. They have to go somewhere else.
But not only that, the market's just stagnant. But
here's the thing I heard from one of our friends, Miguel. He was telling me that he actually just took a listing for a house, and they're selling it because the person who lives there needs senior care, dementia care, and so they're selling it so all the proceeds can actually go to provide for the care for the Alzheimer's. Yeah, I'm gonna say Alzheimer's patient, but for the family member that is in decline. Yeah, and so you'll probably see some of that continue as you have baby boomers aging out, and people need more more advanced medical care, that could be it's going to be a reason that there's some listings, but it's certainly not going to be, by the tens of thousands.
Yeah. I mean, even with these rates increasing, Andy, again, because of that low inventory, we continue to fuel the prices of just increasing in these areas, Seattle, San Diego, San Francisco. You know, I really think San Diego is going to become the next San Francisco at the pace we're going.
Yeah, I mean, and again, we've mentioned a lot of these on the show before because you're talking about, landlocked to the south because of the border, landlocked to the west because of the ocean, and to the north you got Camp Pendleton. So our county, as it were, really only goes up or east, and even east you start running into some roadblocks.
And here's another off topic. Here's another thing of San Diego, of why I love investing here also, is because we are such a huge military town. They're anticipating that in 2 years, they're going to also receive, on top of their BAH, they're going to receive what's called a COLA, cost of living allowance.
Adjustment,
or adjustment.
Yeah.
And so that's going to entail about another $1,000 to $1,500 on top of whatever they're doing already. So what is that? How is that going to benefit the?
Is that to subsidize the BAS?
No subsidy. It's in addition to.
Well, not in addition. I mean, is that to make up for the BAS not being corrected on the cost of living?
Possibly,
because the housing allowance is already cost adjusted every year by the VA.
Yeah.
So
now it's going to be on COLA on top of that.
Wow. Okay.
Which is that is going to make it now where the actual veteran or the active service member or woman will be able to purchase a home, like really qualify.
Yeah. Well, I mean, that's already who we're getting in now is active duty military.
It is, but it's because we're getting dual income.
That's what I'm saying.
If it's a single income, you're talking about an E5, E6. You're talking about they're affording $450 to $550, and what do you find here in San Diego right now?
Right. No, you got to have that dual income.
And that's why I think they're probably bringing in that COLA in. So now they take somewhere they're able to get into that $700-800, medium price range here,
which basically just secures demand.
That's it.
Yeah,
exactly.
Wow.
So,
okay.
Yeah, crazy conversations here.
Well,
and we're going to continue to have those.
Let's more crazy coming.
Yes, more crazy coming.